Hey everybody, Chris Miles here. We are live. We are live here. I know some of you guys are watching the recording right now, while other of you guys are starting to jump on live. And so definitely welcome those of you that are here today, whether you're watching the recording or you're here live as well. But super excited to be here because I know that this is something that I get asked all the time, and it's becoming a bigger and bigger topic the more we talk about it. And not just the more we talk about it, heck, even if you go out and look around what's going on right now, there are a lot of people searching this. They're looking it up. They're trying to find answers. And the truth is, there's a lot of answers that aren't being answered or given, I should say. Don't want to sound too redundant, but there are a lot of information that's out there, and people are still confused. And so, I really want to talk about today how to unbank yourself, how to get yourself away from potential of bank failures and the things that are going to be happening here. So, those of you joining live, please say hi. Tell me where you're from. I love to see that because I know I'm about to go into our mode here, our presentation mode. I won't be able to see anything. So if you're on live right now, go ahead and say hi. Tell us where you're from, whether you're in the U.S., whether you're abroad. Definitely welcome to see. Welcome to whatever. Welcome. I'll just say welcome. Okay. All right. So, anyways, I'm gonna have to jump in here and really go into this a little bit more, help you understand who I am. I know some of you guys already know, you've already been following me for a little while others, this might be your first exposure to this. So, Sean, welcome from Jacksonville, Florida. Love that area. I was actually just in St. Augustine recently and just flew away from Tampa yesterday. So, we got Mark in Hawaii. Good to see you, Mark. Always good to see you again. Cheryl, hey, good to see you from Colorado as well. So, got lots of you guys here. Kirby from Maine. All right, we almost got sea to shining sea here, and then even in the Pacific of the middle of the Pacific too. So, all right, I'm just going to jump in because I want to make sure that we've got enough time and maybe even give you guys some questions too. So, I'm going to find the right view here for you guys. Let's do this way. There we go. All right. So as I said, like really, we're going to talk about like how to get your investment money to pay you twice, how to unbank yourself, get away from those banks and things like that. About me, I'm actually in Utah most of the year, although we do for about 1 month or so of the year, we do leave for the winter just to get away. That was one of the agreements my wife made. She and I have a blended family together. We have 8 kids between the two of us. I've got 6, she's got 2. Therefore, she's the one that's most stressed because she had to make the biggest adjustment. And when we got married, she said, Chris, I, you know, I'll marry you, but we got to make sure of 2 things. One, no more kids. We can't have any more. And then 2, I can't do any more Utah winters. So I'm planning to leave, go to California or somewhere warmer each winter. And I said, let's do this. And it's actually become a tradition for our family to be able to go and do that. And people always ask, do you take all 8 kids? No, my 6 kids are in public school, so they don't get to go in the middle of the year. But her 2 are public or homeschooled, and so we get to take them as well. And occasionally we'll bring maybe one of my kids or something like that as well to give them that experience. So I've been very blessed because really we've been blessed to be financially independent, right? Meaning that I've got enough passive income coming in and then some to be able to pay my bills and really work because I want to, not because I have to. And that's really a big focus. I mean, you can see here the sign is like live your life now, not tomorrow, right? I mean, so many people tell you to delay your life for someday, but never address the here and now. Like, how do I actually have prosperity and wealth today, not just someday down the road that I may not even be alive to experience? And so that's really our focus as we do like cash flow consulting, passive income consulting, helping people get out of the rat race, help them strategize and game plan so they can really get financially independent within the next sometimes 10 years, where they're not worried about paying their bills. They don't have to worry about whether they get laid off from a job or their business suffers because of another shutdown or something like that, like in 2020, right? Like that's what the big thing we teach. But one thing that makes us very unique and makes us better at something than anybody is what I'm talking about today, which is how to combine this concept of infinite banking with this passive income and how to really make it all work together. In fact, to speed up your progress. And so that's the thing is like, if I can show you how you can store your savings, that's safer than the bank. You could be tax free because if you think about it, a bank, you make a little bit of interest, but you get taxed on point nothing percent interest. You could be protected from sue happy crooks, right? Those people, especially, if you look nationwide, Americans especially, we are sue happy people, right? And so if you could have your money 100% protected from that, and get a booster to your passive income where you can actually get there faster, Hey, if you want to do, how many guys would love that, right? How many of you guys would actually love to be able to see that actually in action? And that's something that we've not only I've done for myself, but hundreds of our clients have done as well and have that working in their own lives. So, how many guys want to see that? Hopefully it's a yes. Go ahead and type chat yes or just Y if you're lazy. If you don't want to put the extra ES on the end, just put Y or N, if you don't want to do NO. But hopefully you want to see that, of course, because that's what I really want to talk about today is that focus, is showing you that thing. But let's address the challenges, right? There are a lot of headwinds facing us right now. First off, we got the stock market is come back up to about 2021 highs, right? Like it's not, well, almost 2021. It's still about trying to catch up back to 2022, but it's not quite back up to where it was in 2021. That's for sure. Is that the market's kind of come back a little bit? It's made up some of its losses, but it's still down from where it was a couple years ago. And the thing is that there's even mutual fund money managers right now predicting that the market could actually crash by 50%, by cut in half. What would happen if your money, especially if you have money in 401ks and IRAs right now, what would happen to you if that all of a sudden were cut in half over the next year or two? That's something that's kind of a big issue right now. So people are like, well, do I keep money in the stock market? Like it's kind of making a comeback, but is it just false hope, right? Is it just fooling everybody, as they call it, like that dumb money, right? As the money comes in from more common folks that put their money in, and then all the big money, the people that know what's going to happen, pull their money out when it goes up, and then you're left holding the bag. And really, you're not left holding the bag because your bag gets cut in half because you lose 50%, right? So what do you do with that? How about the fact that the government just raised the debt ceiling and they can't figure out how to pay for it, right? I love this meme here, talking about your tax deferred IRAs and 401ks that the government knows they've got debt to pay off down the road. Well, do I want to store my money in a place like that where they could easily tax more than the savings, quote unquote, savings or deferral of your money that you have today? And then, of course, we got banks because you say, well, maybe banks a safe place. But no, we just had the second largest bank failure in history happen with Silicon Valley Bank. Actually, really second and third largest. If you also include Signature Bank as well, right? Washington Mutual beat it in the last recession, but we had two huge bank failures. Plus, it's not just the US. Even in Switzerland, we got the Credit Suisse, right? We got Swiss Bank. They also failed. They had to have Europe bail them out. And the funny thing is in the news, I haven't mentioned that as of last week, the last number I saw, there's already 54 bank failures. That's about 50 more than we haven't even really heard about at all. So these bank failures have been happening left and right. So do we want to keep our money in the bank, especially when the FDIC can only secure less than 2% of bank depositors' money? That means that if 10% of banks fail and they only have 2% reserves, they're broke, quickly broke, right? And so where do we keep money? Where do we store it? Right. And then we also got inflation kicking our butts, right? I love this where he's like talking about 2% inflation, but, or 2% raise, but inflation 6.5%, right? Inflation numbers just came out. But on top of that, you got the freaking feds who, going crazy with interest rates, right? I saw this meme. I couldn't stop laughing today. So I just had to put this in just to share with you guys, but I was just laughing my head off. So that's probably why I was a couple minutes late. It's just too much laughing. But yeah, we got interest rates. And even though they paused them, funny enough, just yesterday, Jay Powell kind of slipped out saying, oh, yeah, we're just pausing it for now. We're expecting 2 more rate hikes. Oh, sorry, I didn't mean to say that. So now people are saying, wait, there's more to come? Like they're already high enough as it is, right? And on top of that, just where do you put money in general? Where can you even invest it? Even people that I know, like our clients in the alternative investment space, they're still kind of worried about where to put their money, even if it's real estate backed, even if there's real assets backing it up, there's still a lot of things happening there. There's predictions that there are some real estate values that could tank. And I kind of agree. There could be real estate values that tank. I will say this as a little extra bonus or secret. That's not the focus of this one, but the cool thing is that usually when we work with our consulting clients, we focus on cash flowing investments where we don't even care if it tanks. The value tanks. As long as there's cash flow there, there's profit, doesn't matter. But that's a little extra side note there that I'll actually do a webinar on that in a couple weeks here. So we'll talk about that later. But anyways, again, it's so hard to know where to put your money, right? And so people are keeping it in banks. Some people are keeping it in the market, but again, they know. And maybe you're just like this. Maybe you're thinking, is this really the best place to put it? Because if I put it in the bank, I'm going to lose to inflation. There's no doubt. If I put in the stock market, I could lose in general and then really lose to inflation because you lose half your money and then inflation keeps skyrocketing. You may never come back from that. I mean, there's people that really from the highs of 2000, and my dad included, who's one of those people who got burned by that. I mean, 2000 really, it's just barely almost coming back to meet inflation from where it was over 20 years ago, guys. It's just ridiculous. And so there's got to be an answer. And so I want to share with you what I've done with my own money, how I've unbanked myself. And actually, I've been doing it over the last several years. It's just now it's become very timely, right? Because we want to make sure that we protect our money, we keep it safe. Because it's not about the return you get on your money, although we like the returns on our money. It's about getting a return of your money, not just return on your money. You want to make sure that the money's there when you need it the most, right? That's the whole reason why people have been using banks in the first place, because they expected that you put your money in the bank, you'll be able to get it whenever you need it. Well, what if they start to fail? Well, what do we do then? That's what we want to talk about today. By the way, I will talk about how you can use this and blend it with that other topic of passive income, how you can actually use this strategy to get you out of the rat race faster, meaning you can become financially free where you don't have to worry about working that job or your business to pay the bills. So this strategy can actually work in tandem together and get you there faster. So we'll kind of cover that towards the end. All right. So here's the thing is that most financial people, the financial pundits in the world, they just don't get this strategy. And even the strategy that's taught out there, we're talking about here, like when we talk about infinite banking, which I'm going to talk about here, it's not the same thing. It's not even what we're talking about today is a very different strategy. But really guys like the Dave Ramseys of the world, they poo-poo all over this kind of stuff. I mean, you look it up online, you can find it. They poo-poo all over it, usually with a bunch of misinformation and half-truths that really don't apply. But they sound passionate, they sound convinced, and as long as they sound convinced and passionate, it's got to be true, right? That's what every politician has said. So it's not true. But I'm telling you, banks have been using this strategy. Even the banks that have weathered those storms over the decades and centuries have actually been using this strategy for years. In fact, during the last recession, they actually put more money in this strategy just to create more safety and leverage of their cash that they have. So banks have been using this forever. We even had Eddie Wilson, who's came from a family of bankers. He even talked about it on our interview on our podcast, the Money Ripples podcast that we did. So it's not uncommon. And guys, there's even people like Warren Buffett. At the end of 2022, Warren Buffett had 125 million sitting in cash. Sorry, 125 billion with a B sitting in cash. Now, as of 2023, what we found out last month, he's now got 130 billion sitting in cash. That's 20% of his portfolio sitting in cash. Why? Because he knows that there's a storm coming. But he also knows with every storm, there's also sun, right? He also knows that there's that eye of the storm, right? There's that break that gives you that opportunity to be able to make a lot of money. Understand in the last Great Depression, guys like Joseph Kennedy, John F. Kennedy's dad, went from $4 million in net worth in 1929 to $100 million in net worth in 1935, 6 years later, because he had the cash available. He kept it safe, not locked up, funny enough, not locked up in banks as much. He kept his money in different places to store it and keep it safe. So what we're going to talk about today is that max ROI infinite banking that we refer to. This is using the vehicle that's high cash whole life insurance. That's right, the boring whole life insurance that your grandparents might have bought. That's what we're talking about here, but very different. So don't just think, oh, great, it's another, insurance type strategy here or something like that, or some, gimmicky thing. It's not, guys. This is literally where I'm storing money. And this is where I'm teaching our investing clients to also keep a good amount of reserves and to keep it safe while making tax-free better returns. Now, I'll tell you a story because, when I started as a financial advisor, and again, I'm not a financial advisor now, right? I don't call myself that. I'm an anti-financial advisor, if anything. Now, I'm more about helping people become financially free, not saving money forever, only to find out that the strategy doesn't work, which is what I found out, 20 plus years ago working as a financial advisor. I'm going to save more of that story for later. But as I started to realize that there's this whole other world, right? And especially when I started to meet other real estate investors, and this is what really helped me get out of the rat race in the first place. These real estate investors started talking about this infinite banking thing. I was like, what are you talking about? Infinite banking, infinite banking. What is that? It's like, you don't know what it is? No, I don't. I was a financial advisor for 4 years, never even heard that term before. They said, oh my goodness, it's the best thing ever. And they talked about this whole Nelson Nash book, becoming your own banker, right? And so I read that book And I was pretty impressed realizing, because when they said whole life insurance, I was like, oh, come on. Whole life sucks. There's nothing good about it. Now, my opinion came from other financial advisors I worked with. I had no personal experience with it. I was just reiterating what I heard from other people. This is like what I get like online on our YouTube videos. Sometimes we'll have people say stuff. And in fact, we just had somebody just this morning email us today and say, because they comment on the YouTube video saying like, yeah, but how do you get one of these things where you don't, you have to wait 4 or 5 years to get money? And I said, actually, if you do this right, you get money from day one. So she reached out. She's like, all right, tell me how you do that, right? That's the thing, is that there's a different variants of it. And so I was always told that this thing stinks. It only makes you 1 or 2% a year. You might as well have a CD than have this, right? And that was kind of what I was taught. But what was interesting is that, I ended up seeing the light. I ended up realizing, like, wait, we can leverage this thing. I can actually make money with it. And they would even tell you things like you pay yourself back interest, and you can use this instead of using the banks, for loans and things like that. And so you can buy your own cars or buy houses with it. And so I bought into that Kool-Aid, right? And if you ever seen anything about infinite banking, this is the traditional thing that's taught. That being said, I bought a policy from a guy because I was like, hey, even though I'm life insurance licensed, I didn't know about this. So I went to a guy that everybody said, oh, we'll make this work, won't we?
Awesome. It's to you now again, Chris.
All right. Cool. All right. So heading back. Well, so, hey, thanks for hanging in, guys. I know that was so freaking random. So as I was saying, I bought a policy back in the mid 2000s. And after a couple of years of having it, like, I remember seeing the cash value, right? And I remember seeing that you couldn't grow that cash value like that lady was talking about, right? Well, it kind of bugged me because I said, hey, is there a way I can make this work better? And the guy that sold me the policy said, no, like, this is pretty much what it looks like. I said, all right, I'll accept it. I'll trust you. Well, 2 years later, the recession hits. I'm in the hole, $15,000 a month. I cannot pay my bills. So as a result, I couldn't keep paying $1,000 a month into this thing. I'd already paid 25 grand into it, and there was only a couple $100 of cash in there. And if you understand how these work, their whole life insurance is not like term insurance. Term insurance is just death insurance. You miss one payment, it's done, right? Like, that's what happens with term insurance. It's just death. Whole life is a little bit different. It has that death insurance, that death benefit, but it also has this tax-free supercharged savings account inside of it too. And so I said, all right, cool. Well, I've got some money in here. Can that help float me? And the insurance company said, absolutely not. No, we can't, because, it's there's only a few $100. You got to pay $1,000. That's what you're required to pay. And so, long story short, guys, I lost that policy after putting 25 grand in. I lost it all. That was like the most expensive, crappiest term policy I'd ever had. And it bugged me. And I found out later that year, I could have designed it differently. And so about a year or so later, I confronted that insurance agent. I said, listen, I found out that we could actually get cash in here from day one. We could actually make this like an actual tax-free supercharged savings account, not something I have to build up long-term, not for that long-term retirement or 10, 15 years. I can use the cash to buy a car or buy a house or something. And we went back and forth. We had a 2-hour debate. It got so heated that the assistants outside the office were getting a little bit nervous because they could hear my voice raising, because I was pretty pissed, right? Because I realized that he could have done it better. Well, long story short, after I battled and knocked all of his little objections and counter arguments that he had with me, it finally came down to one thing. He said, Chris, I didn't design it that way because I couldn't afford to cut my commissions. And I said, there's the problem. There's the answer. There's the truth. And I was so mad. I just said, that's it. I'm not sending you a single referral again. I'd referred dozens of clients to him, and all had the same kind of design. I said, that's not cool. No, you're not going to get a client again. I will tell you this, flash forward now, almost 15 years when I confronted him on that, he's no longer in the business. He has now left the business completely. And that's what I want. I want people that are like that, not in the business. And that's kind of why we talk about this, like, no BS infinite banking, right? Because when we do this, like, one, we want to make sure, first and foremost, you get the highest cash in this, which means lowest cost, highest cash every single time. No BS, no exceptions, no, hey, well, if I just do this or do that, I make more money. No, that is just hands down out of integrity. that is violating our process. Even the guy that I have on my team, Parker, no, like he knows if he does not obey this one thing, he's out, he's fired, he's gone. There's no exception to this rule, because this is what got me so ticked off, and even got me back in the space about 6 years ago again, because when I was referring to a guy that did it better, it wasn't still best. And it just drives me nuts that this industry, there's only a very few handful of guys that know how to design what I'm talking about here. But even the ones that know how to design this way, they won't do it because they're all relying on the commissions. They're not financially independent. They're not financially free. They need this money. This is their career. And I'm not against people making money, but the truth is that scarcity costs you more money. And that's why you've got to understand this so much. So I'm teaching you a different strategy, but I want you to know that you can do this strategy with less money out of pocket. It could save you literally thousands a year. In fact, I just had a guy came up to us at a live event that we did a few weeks ago. And he said, yeah, there's a popular infinite banker. We're doing a policy with him. It's like, oh, good. And I knew this infinite banker. I know he's a good guy, but I also know that they do a good job. They don't do the best. They do a good job. And I asked him, I said, well, what are you doing? He's like, well, I'm putting in 10,000. I've got 6,900 in the first year. I was like, I'm so excited. That's so much more cash than zero, which is the normal policy that you see out there. And I said, that is good. You can do better. We ended up saving him over $1,000 a year. And so we'll talk about that here. So anyway, the thing is that this is not super difficult to understand. It's not overly complex, although there are guys that do that. We did have somebody that came to us recently that had spent 2 years researching this with a variety of companies, including one company that did 6 meetings, 6 different phone calls trying to educate him on how to do this stuff. He was still confused. It took us a half-hour call. So this doesn't have to be complex, and basically you're going to get the information that we do in a half-hour call anyways, other than just running your own personal numbers here. So anyways, so let's start off with who this is not for, because I don't want you to think this is for everybody. It's not the perfect thing since sliced bread, even though it's awesome. It doesn't work for everybody. So for example, if you're over the age of 70, this is the strategy you're probably not going to use as much. If you're over the age of 70, we're more looking at estate planning more than worrying about how to try to build up cash in these things. 2, if you're paycheck to paycheck, like literally you are not saving a dime each and every month, this is not a strategy for you. I will say this though, you can buy a term policy that can convert to this later on that you can do, but you want to make sure you get the right kind of policy so that it converts to the right one as well. But if you're paycheck to paycheck, I would just say buy simple term insurance in the meantime and get that cash flow up. As a bonus for you guys, kind of a bonus gift, I wasn't planning on this, but if you haven't been to our website, moneyripples.com, we actually have an ebook on there called Beyond Rice and Beans, 7 Secrets to Free Up Cash Today. If you're that person that happens to be paycheck to paycheck right now, and you're trying to find more money, especially with inflation kicking your butt, that's a great, easy read. It's like a half-hour read at most. You could read it during your lunch. While you're eating lunch, literally read it, figure out how to apply it. And we've had people free up at minimum $300 a month. In some cases, we've had people free up thousands of dollars a month that then could be used to start doing a strategy like this if you're trying to pack money away. We even have people that have been putting money in 401ks but stop funding their 401ks to do this instead so they can retire before the age of 60,000 years old. So another thing this is not for is those that are in bad health. If you're in bad health, you're a smoker, things like that, then this won't work for you as much. But the cool thing is there are ways around that too. For example, I had a client where he was about 350 pounds, in his mid 50s, not in great health. And he said, Chris, even if I get approved, I know it's going to be super expensive. He said, but could I do a policy on my wife? Because she's a few years younger than me. And by the way, women live longer, so they're cheaper anyways. She's a few years younger than me, and she's in perfect health. I said, let's do it. And we did. Instead of a big policy on his wife instead, and he saved him literally hundreds of thousands of dollars over the last 5-6 years. So again, this is not for those in bad health, paycheck to paycheck, or those that maybe are over the age of 70. Now let's talk about more what it is. Okay, so this supercharged savings account, like I said, there's this cash value or savings account, this tax-free savings account inside this life insurance policy. It's separate from your death benefit, although it is tied together, but it is something that can be used separately. You do not have to die to get to this money. And like I said, if it's done right, you can actually get to it. Some companies will say not tomorrow, but they'll say wait 30 days. So wait 30 days after the deposit, mainly because it's actually such a popular thing. It can be done well enough that terrorists even use this. So it's a common money laundering tool because it is liquid. It can be used easily. So they make you wait 30 days just in case, so they make sure you're not somebody that's trying to fund Al-Qaeda or something. So anyways, as I mentioned, it's tax-free. So this is a lot like a Roth IRA, but without all the stupid rules. Okay, so you put in with your after-tax money, so just money you put in like in savings account or checking or whatever, it's after-tax dollars. You put it in, it grows tax-free and it comes out tax-free. And in most states, it's a 100% from lawsuits and creditors. That means you can have literally millions of dollars in here, and somebody sues you and wins, they cannot get to this money. They can draft right out of your savings account without you even wanting them to. They'll do it anyways. They can pull your money out of IRAs. They can pull your money out of just about anything. But this is one of the only places you can keep your money where if somebody sues you, including creditors, even if creditors have liens against you, they cannot put liens or get access to this money. It is safe from that. Again, that's in most states. There are a few states that have the exception. But even then, they still have certain limited protection there too. The other thing too is it's guaranteed growth. Guaranteed usually at least 3 or 4% a year. In most of the cases though, they're paying currently, even as interest rates are just starting to rise for life insurance companies, they're paying at least usually 5.5 to 6% currently right now. So that's 5.5 to 6% tax-free. For those of you in higher tax brackets, if you start doing the math, that actually means you probably make a bigger return than the average stock market return. I'm not saying it's going to beat the stock market because you just never know, right? Nobody knows the future, but I'm just telling you here that even when interest rates were higher, like in the early 2000s, these things were paying pretty close to about 9-10+% returns. Okay. The funny thing is nobody paid attention to them because the stock market up until 2000 was paying people like 12-18%. I remember when I first came in the industry, they were expecting like, oh, you can make 15-18% returns. Then Y2K happened, and all of a sudden people got somewhat back to reality again. Like I said, there's no stupid limits or penalties. You can access that money. There's no 59.5 rule. You have to wait till you're 59.5. There's no 10% early withdrawal or other additional fees like that. Nothing at all like that to access the money. You can get bank leverage. I'll talk about that in a little bit too, about how you can actually leverage this to get better interest rates with the bank. And of course, like I said, you can get access to cash now. Another bonus too is that you can actually, this is kind of cool as well, you can actually use this money to qualify for mortgages. So when mortgage companies are looking for you to prove that you have funds, that you have savings, they'll actually let you do that. So that's kind of cool. And even cooler, if you're trying to get your kids college financial aid, they won't count this as an asset. So even if you've got millions saved up in here, they won't count this as an asset against you for getting your kid financial aid in college. So there's lots of wealthy people that can still get financial aid for their children going to college because of this very strategy. All right, so here's ways to use it. Here's what I use it first and foremost as an emergency fund. So we recommend at least 6 to 12 months of expenses. So if your expenses are, say, $10,000 a month, we recommend having at least $60,000, $120,000 sitting in cash that you do not invest. Even if you could create passive income from it, don't. You need to have liquid cash. So many times people will say, well, what kind of money would I put in this? Well, this money. Because if you can earn better than 0.nothing% and not get taxed on that money, for that matter, because you can earn at least net 4 or 5% tax-free returns, put more money in this place. And this is actually something that can even outperform even the online savings accounts out there today. And there's some good ones out there now that rates have come back up. But, again, you still get taxed on that money. Here you don't. There's no IRS involvement at all with this money. It's completely off the books that way. So a great place to store emergency fund, and especially if you want to protect it from other potential lawsuits, creditors, and things like that. So like, for example, my wife, she wants me to keep $300,000 sitting around that we don't touch. And I knew that $300,000 sitting in the bank earning 0.nothing% is going to make me nothing. So instead, I said, let's earmark $250,000 of that money to be in the life insurance and then keep only $50,000 in local bank. So that's what I do is I unbanked myself already by only keeping a little bit in the bank just for that quick, overnight access, or even just walk into the bank and pull out money. Where here, I know I can get this money in about a week, give or take, depending on transfer times and things like that. So that's the great thing is I can store most of my money here, protect it, grow it faster, and of course, don't have to worry about taxes. So even if you make, let's just say you net 5% on this account, right? You net 5%, but in my case, like 5% on even 250,000 is 12,500 a year. That's a lot more than earning 0.1% at my bank, where that would make me $250 in a year. So I'm making $12,000 more tax-free just by putting it there versus keeping it in the bank. So cash flowing investments. So when we talk about people investing like with real estate or other types of investments and things like that, you have cash flowing investments. You can make a lot of money doing this. And I'll show you an example of how that works, where if you ever buy cash flowing investments like real estate, you'll never want to use your cash again when you see how this works. Collateral. I said I was going to mention this. I had one client who he was trying to buy a commercial building to be able to have his business in. So he wanted to buy an office building. Well, he knew he was going to have to get some extra money for build out. And so he said, Chris, I'm thinking about cashing out this life insurance policy I have. Maybe I'm just going to cancel it, take all the cash out of it because I'm not really using it. I was just letting it sit there. And I said, hold on, Sparky, before you do that, let's just pump the brakes a little. Let's instead go to your local bank or credit union and ask them, will they give you a collateralized line of credit? Because the cash that's in here, they know it's guaranteed to always make money. It can never lose money. It's always guaranteed to always pay you and always grow. That's the great thing about whole life that you cannot get with any other life insurance, including universal life, which has become more popular lately too. So it's the only one that's really guaranteed to keep growing. And so I said, go to your bank and ask to offer that as collateral to go with the building. He did, and the bank was thrilled because banks don't like to take risk, right? They like to take low risk. They believe low risk creates high returns, which is true. Low risk does create higher returns. So they said, hey, we would love that. In fact, you know what? We'll even give you a 2% reduction on your interest rate. So he got 2% lower than the best interest rate that the bank was offering because he used this as extra collateral to go with the building. Long story short, they gave him more money than what was in the insurance because he had a building too. Gave him more money. He did all the build out, started getting renters in it that paid his low mortgage payment for him because it was dirt cheap interest. And then guess what? Year and a half later, he went to the bank, said, hey, the building's done. We've got renters. I think the value's there. Can we take the lien off my life insurance? Because they were using that life insurance as the collateral. Can we take the lien off it? Can we take that lock off of it, so to speak? And the bank said, yeah, absolutely. And then they kept him at the same interest rate. So they didn't raise the interest rate on him at all. They kept it the same dirt cheap low interest rate, which is it's a no-brainer for him. So he's making lots more money because he used that as collateral. Many times people will use that as collateral. I'll talk about some other examples too, just to even start a business, right? There's lots of ways to do that too. Pay off loans. A lot of people have been asking this lately, especially as interest rates have been climbing. Paying off credit cards, great. I would not recommend. I just had somebody ask me this yesterday. They said, I just got offered at the bank 6.44% for an auto loan. Should I just use this infinite banking policy instead? And I said, no, I would actually still use the bank. Get as much cheap money as you can from the bank, and 6.44 is still relatively cheap. Same thing with mortgages. Get the cheap money from the bank as much as you can. The money that you can't get from the bank, just like a down payment on a property or money that you would invest like maybe in a business that they may not give you money for, that's the money you would use. And not to mention keeping cash reserves. It's very important, especially if we move into a deep recession, which I predict we will. So you could pay off loans. So high interest loans and things like that, you could pay them off and free up tons of cash. Retirement income. That's the thing that's usually sold with this. Yes, it can provide extra retirement income. I'll show you an example of one of my clients who's actually going to do that, where a lot of times I forget to tell people you could actually use this as tax-free retirement income before 59 and a half. So if you want to retire before 60, guess what? You could actually use this money as tax-free income. And then, of course, I mentioned kids savings. A lot of people are canceling their 529 college savings plans because they're high risk. And it's just last year, people had kids going to college and the market tanked on them. That just killed a lot of their college planning. Not to mention, what if your kid doesn't go to college? Or what if they get a scholarship and they don't need that college money, but you have to get slapped a 10% penalty for trying to use it for something other than college? This is something that gives you all that flexibility. So, all right, let's talk about double arbitrage. And again, like if there's comments and questions, go ahead and put them in the chat. I'll answer this at the end here. But I want to talk about this double arbitrage. If you don't know what arbitrage is simply this. Walk into your bank and look at the sign or the TV screens that are on the wall, and you'll see that they'll advertise like an auto loan. Maybe they'll advertise an auto loan at 6.5%. And then you'll see, that's a 5-year auto loan, but then you'll see on the other side or the other screen, you'll see a 5-year CD at 3%. So 3% for the CD, 6.5% for that auto loan. And you realize saying, wait a minute, somebody can lock up money in a CD for 5 years, only pay me 3%. That's the cost of the bank. That's their debt that they have to you as the saver, right? They pay you debt, pay you interest, but then they're going and making 6.5%. And by the way, that's not a 3.5% return. That's over 100% return that they make on your money because of what's going on there. So that's a big, big deal. That's what arbitrage is, right? It's about how you make more money than what you're actually getting. How do we do that with this banking system? The great thing is that instead of just putting your money into savings account and then investing it, instead we put the money in this policy. We put it in this cash value. Now, as this cash value builds and grows, you can then get what you see right there, a loan from the policy. Now, why? Someone would ask me this question. They're like, Chris, why would I borrow my own money? And my answer is simple. You're not. You're not borrowing your own money. You're borrowing it from the insurance company like they're the bank, just like my client did when he went to that credit union and borrowed money to be able to build out that building that he had. Same thing. They're just using your cash as collateral, and they know it's guaranteed, even the insurance company. And they'll give you a line of credit against it, usually up to 95% of whatever's sitting in there. So what that means is that you can borrow that money from the insurance company. Your money's still in there. Think about this. This is how powerful it is. Say that you have $100,000 that you've built up in there, and you want to use $50,000 to invest. Now, normally, if you had it in a savings account, you pull out the $50,000, you invest it. Great, your money's making money off that investment, but your savings account is not making as much interest anymore, is it? Because you just withdrew the money. But here, if you do this kind of strategy with this infinite bank type strategy, instead what you're doing is you're now borrowing from the insurance company or even a bank. You borrow this money from them. You pay them interest. You do not pay yourself interest. Do not believe that little half-truth lie that they give you out there. You're not paying yourself interest. What they are doing is they're always paying you interest. So in that same 100,000 example, you borrow 50,000 out of that line of credit from the insurance company. Your 100,000 is still in there earning tax-free compounding interest. That money's compounding each and every year, growing each and every year. While you pay the insurance company or the bank, you're paying them back simple interest. Now, I didn't put on all the equations here. I would recommend this. If you want to get really into the weeds on how you can actually make more money than the bank, even if they charge you more in interest, there's a podcast you'll see on our Money Ripples podcast channel on YouTube called The Miracle of Simple Interest. And we actually talk about how you could actually have a 6% mortgage and still beat by saving your money, earning over 3%, earning really 3% a year, you could still beat a 6% mortgage. So kind of a cool concept there. But in any case, here's the key thing I want you to realize is that you're earning more in interest from the insurance company than what you're paying them. So what happens, you're making money there, but you still got the money access to go put in that investment. So now you're making money in the investment and you're making money inside the policy. You're making money in two places at the exact same time because you never stop earning those dividends, those tax-free guaranteed dividends that you get from the insurance company. You never stop earning those, while at the same time you're able to leverage, borrow the money from the insurance company, still keep making more interest on the side there, and invest it too. And here's the cool thing, guys. When you borrow from the insurance company, guess what? There's no minimum monthly payments. You pay back the loan, however, whenever you want. The deadline is at death. So the only time that they actually require the money to be paid back is when you pass away. And what do? They take it from your total big death benefit. They take that money back out of the death benefit and then pay the rest of it to your family tax-free. So it's one of those things where it's not like a bank. It doesn't show up your credit score or anything like that. It's not like a bank where you have to keep making payments. Even real estate investors, a lot of times they'll have lines of credit with banks. But the thing is, if they're trying to do a renovation of that building, so they're not making any money on it. They have to renovate it and do stuff to it, and then turn around and sell it or rent it later on. They're not making any money in the process, but they still have to keep making payments to the bank. But when they use this strategy instead, yes, it charges interest, but they don't have to pay that interest. It's almost like a student loan that's in deferral. Yeah, they'll charge you interest, but you don't have to make any minimum payments on that. So anyway, that's the key thing. But the best way to use this, of course, is if you use it for the investment, put that money in the investment, and then take the cash flow from that investment and use it to pay back towards that line of credit, freeing up more cash to invest again later. So instead of just using a simple savings account where you liquidate that savings account and then you have to wait for the cash flow to build it back up slowly while you're earning nothing percent, instead you can use this, earning a better return, and build that money back up and reinvest it again and again and again all you want. So let's give you an example. I'm going to use a big example here, right? Here's a small apartment. Say you want to put $250,000 down on this apartment building.
And let's just say the cash flow is $2,500 a month. For a lot of my real estate investor friends, this is a very small return. For others in this kind of market, it might be a little higher. It's just give or take, right? But I want to use simple numbers for you. But remember, if you had a savings account where you liquidate all 250,000, well, now you're gonna be taking that 2,500 a month and building it back into that savings account again, slowly over time, right? Now, what if you did that strategy versus doing life insurance, right? So if you use your savings account and you earn a whopping 0.1%, my bank's not even quite paying that yet, but you're earning 0.1%. After 9 years, here's what's the kicker, right? 9 years, you just paid back $270,000 back into your savings account. Yet, because you get taxed on interest along the way, you only come out with about $1,200 of interest. And that's it. So out of the $270,000, you now have $278,000. That's it, guys. Like you hardly made a dime putting that money back over 9 years. But what if you did that same strategy with the life insurance? Guess what? 100 times that. Excuse me, I'm getting all choked up here. 100 times that. By the way, I updated these numbers, even with the current environment. It used to be more. I even brought it back down. So this has even brought it back down more conservative numbers. Doing that same strategy you would have done here with a savings account where you're just taking that $2,500 a month, putting it in savings and growing it. Over here, even this is net of even the interest you pay the insurance company, you still come out with about $127,000 of profit. Huge. Guys, think about that. That's $127,000 on top of the $270,000 you just saved. What does that mean? That's $126,000 you could actually be using to invest to create more cash flow. For my clients, they know they could easily make another $1,000 a month potentially or more off that extra money in just 9 years. That's the difference, guys. That's how you make money twice. Now, let me give you examples of people who have used this already, right? We've got guys like Walt Disney. Walt Disney, when he already built Disneyland, it was a success. He wanted to do Disney World. He was kind of keep on the low down. He's trying to buy all the swampland in Florida. And he wanted to do the project. He went to the bank for money. And the bank said, Walt, we appreciate you doing Disneyland, but you're crazy. All right, to do this, buy all this swampland and make something even bigger. Why don't you just keep this small? Walt didn't have that kind of dream. Walt had bigger dreams than that. Maybe like you do too. Maybe you want to do bigger things. He said, no, I want this to happen. And so what did Walt do? And this is public knowledge. You can watch documentaries and it comes up in documentaries all the time. Walt went and leveraged the cash that was in his whole life policies. And he said, what if I put this up as collateral? And the bank said, now you're talking. And they gave him the loan and the rest is history. Now you also have companies like McDonald's. Do you know that Ray Kroc, when he bought it from the McDonald's brothers, to keep the executives on his payroll, he had to start cashing from his policy to be able to help keep those executives on board so that McDonald's would still essentially be big and become what it is today. Also, if you ever use Pampered Chef, you might recognize this woman on the right. Pampered Chef seed money started with using her life insurance. By the way, just so you know, guys, just as a side note here, whole life was the thing that was popular before 401ks. This is what everybody was using. If they were going to be saving money, they didn't put money in the market because they went through the Great Depression. They saw how much money you could lose. That was a gamble. They put money here. The thing is that there's so many financial advisors and so many companies that make more money selling you other pieces of crap out there that this thing just kind of got ignored, right? It's just like, oh, that's just old. That's boring. But it's been proven to work for literally at least a couple hundred years in the United States. Pretty much since the country was founded, there was life insurance companies doing these kind of policies. Buffett, by the way, uses the strategy, but he does it differently. He doesn't buy policies, right? He buys the entire insurance companies. He's so confident in insurance companies that he does this. Here's an interesting thing to note, because I mentioned about FDIC and your bank savings not being safe. Well, people will ask all the time, what about insurance companies? What if they go under? Well, let me give you some historical lesson here. One, if you go back to the Great Depression, did you know that there was over 35,000 banks in the United States? After just a few years into the Great Depression, you know how many there were by about 1934, 1935? There's about 13,000 banks. Guys, that means like almost 2/3 of banks failed during the Great Depression. Guess how many life insurance companies failed? 4. 4 did. Why? Because unlike banks, like in the Great Recession, things like that, they can't over leverage themselves. Insurance companies aren't allowed to do what banks do, where they loan out more money than what they have in their possession. And so when people start trying to pull out money from their deposits, and plus people can't pay their loans, banks fail, right? This is what we saw with Silicon Valley Bank. Banks fail because of that very reason. that kind of stuff happens for banks. Insurance companies don't have that ability. They don't have the ability to go and lend money to borrowers and things like that. They just invest the money that they have. It's dollar for dollar. And even if they could fail, right, which some of them can and will over time, that will happen. The great thing is this, is that you're protected by what's called reinsurance. Reinsurance companies are global insurance companies that protect life insurance companies, specifically your cash and your death benefit. So even if the company fails, they swoop in, they make sure that you're kept whole 100% until either another company buys you up, which is likely to happen, or the reinsurance company just assumes it for the rest of your life until it's paid out. So that's why I keep more money here, because it's not only giving me a better return, it's tax-free, but it's also safer than the banks. Just to kind of give you an example, I said I was going to show you like how people use this to even get out of the rat race faster, how to become financially free faster. One of my clients sent me this as his plan. He said, "Hey, Chris, here's what I'm doing. I've just bought a few properties. You can see his current investments that he had earlier this year. And then he's like, I'm going to start buying some rentals, buying about 1 or 2 rentals every year." Now, he wants to be financially independent by 2030. That was his goal, or end of 2029. Yeah, he had this listed out pretty well, just kind of did basic projections, not even counting in appreciation, all that kind of stuff. He was just looking at simple cash flow just to be conservative. The cool thing that he did that I didn't think about is that he also included his life insurance too. I forgot to put the screenshot in here too, but he shows his life insurance over the years. He could actually pull out $950 a month tax-free. And I even questioned those numbers. I'm like, can he really? Even after just having this policy, he just bought it back in 2021 is when he bought it. And then I looked at it and said, nope, he can actually pull out over $10,000 a year tax-free for a very, very, very long time. So that's pretty cool. Another couple here, the Jorgensens, they actually were on my podcast a little while back. I mainly interviewing them about them getting out of the rat race because we'd helped them become financially independent. Well, they spent a lot of time talking about the infinite banking policies that we did together because they did something that I didn't expect, right? So when I was working with them, just as on the passive income side, they say, "Chris, we've got several of these infinite banking policies from a guy that's pretty well known in the space. Can you take a look at them, see if we should get rid of them or do something better?" And I said, "Well, how long have we had them?" "We've had them for about 6 years." I said, "I don't know. Like that might be usually after like 5-6 years. Usually I just convince people to just keep them, even if they weren't set up correctly the first time and it cost them a lot of money in the beginning. You kind of paid your dues. Maybe we shouldn't replace it." And then, Jay and Chris just said, "Well, can you check anyways?" And so I did. Ran the numbers, shocked me. Because even though this guy was an infinite banker, even had cash from day one, he didn't do it as well as he should have. Not to mention he did it even with companies that really were more expensive anyways. And so what ended up happening is we ended up replacing it, because when I showed them apples to apples, putting in the same money they were already putting into those policies, apples to apples, after 20 years, they would have $2.25 million more in our policy. $2.25 million more, guys. Not to mention they didn't have a bigger death benefit. So it wasn't like we cut the death benefit completely away. They still would have more death benefit and more cash after 20 years. And just so you know, typically, like if you're looking to pull out money, if you ever want to use this as retirement, like tax-free retirement, that extra $2.25 million would actually generate nearly about $200,000 a year tax-free income for them after 20 years. So it's a pretty big deal. Again, apples to apples. They were blown away. I was blown away. I was shocked because I didn't expect it to be that good. All right. Oops. Hold on. What's going on here? Hopefully you guys still see this. Okay, perfect. So again, I'm just telling you guys, like, this is a great strategy to use. Where if you want to get away from banks, it's a great way to do it. It's pretty impressive. It's pretty cool stuff. So I'm going to stop. I have power, but I've got enough power to keep going. Hopefully, you can still subscribe. All right, so I'm starting to see some questions coming in here. Let's see. I want to make sure we didn't miss any from earlier. Okay, so we got the one that we had here is, what's the trick to finding the policy with the most upfront cash? Is it finding an insurance company that charges the lowest fees, or is it finding an agent willing to take the lowest commissions? That is a great question, because I was actually about to ask that and I didn't, or about to mention that. The best way to do this, guys, is have the numbers run. And I'm probably one of the few people that would say, yeah, run the numbers. In fact, if you want to shop us. So you can actually reach out to us, moneyripples.com, right? You can just go to moneyripples.com, go to the contact us page, reach out to us, and we can look for you. The trick to finding the policy with the most upfront cash, is it an insurance company? Yes, the insurance company helps, but you're right. More importantly, it's the agent. And like I said, even though there's agents that know how to do it, they just don't. It's so funny. I had a client recently who, was talking to another agent, and I was like, "Oh, we'll beat it, hands down. That's our guarantee. We know we're going to beat everybody's numbers, hands down." Even like people that try to do universal life, saying, "Oh, I'll make more in the market," we still beat those, even with the boring whole life, because of how we design it. Well, anyways, so he comes back and he says, "Well, I went back to my agent and showed him your numbers, and then he said, 'Oh, well, I can do that too.'" And the client was ticked. He's like, "Why didn't you show that in the first place?" So like I said, it's not that you can't find the best policy, but I will tell you this, that our no BS, type of thing is that we will get you the best every single time. It doesn't mean you have to use us, but it would definitely save you a lot more money. And I even had people that came to me that said, "Oh, this is like my brother-in-law, or this is my cousin, this is my best friend. This person sent me business." I actually had a client where he did have a guy that was sending him business. And so he said, "Yeah, I'm looking to get this infinite banking policy." Now, I knew the agent he was talking to. I said, "That guy's a schmuck. He doesn't even know what infinite banking is. He's just using it because it's a buzzword." Well, my friend still went and did a policy with him. 6 years pass on by. He comes back to me. He says, "Chris, I'm ticked off. I've put into this policy." He was putting in it was about $6,300 a year. That's it. Now, this guy's a millionaire. He was only putting in $6,300 a year. But he was ticked because even after 6 years, where he thinks, "Okay, I've put in now about really $38,000. I only have $18,000 here. I have less than half the money I put in after 6 years." And I said, "I told you, the guy's an idiot." And he's like, "Well, can you do better?" I said, "Absolutely." And I showed him examples where in the first year, he would have about 80% in the first year. So think about this, and that's the same thing happened to that guy that was he was trying to put in about 10,000 a year with a policy, with another agent. And then he said, "Yeah, I'm going to have 6,900 after the first year," which is good. But when we showed him that he could have almost over $8,000 in the first year, he's like, "Whoa, that's saving me over $1,000 a year. I'm going with you guys." Even though this guy spent all the time with me, I like myself more than I like that agent. And that's the thing I found out is like that same thing with that guy. He's like, "It's not worth it for me to pay all this extra commissions to this guy, even if he's a guy that's sending me business. My family is my business. My family should come first. They're the ones that should get the best benefit." So he actually, so he ended up not only doing a policy, he didn't do one for $6,000 a year. He actually ended up doing one for $50,000 a year. And because he knew he's going to have $40,000, give or take, in that first year from day one, where he didn't even have anything close to that, even after paying almost that same amount over 6 years when the costs get cheaper. That's one thing with whole life. Whole life is more expensive up front, it gets cheaper over time. But that didn't work that way. And just as a follow-up, just so you know, that guy that was doing $50,000 a year just set up another policy last month for $100,000 more a year because he's too scared to put his money with banks. And so as a real estate investor, he's like, "I'm going to put more money here. This is the one place that's been safe." So yeah, appreciate the question. The next one, how much would you recommend someone be able to typically save on a monthly basis before considering getting an infinite banking policy? Thank you so much for bringing that up. The lightning storm threw me off a little bit. I would recommend this. If you're saving at least $5,000 to $10,000 a year, this would make sense. So when I mentioned paycheck to paycheck doesn't work, but if you can put away at least $5,000 to $10,000 a year, and that's a max amount that you can save per year. That's one difference with our policies too, because the policy I bought, the minimum and the maximum were the same. There was no wiggle room. I couldn't do anything. That's why I lost so much money from it. With our policies, for example, I actually just last week, we just had a guy that did a policy for only $5,000 max contribution per year. His minimum required premium though is only about $1,000 a year. It was actually like $900. I'm just rounding up. So it's like $1,000 a year, right? And by the way, the older you are, the more that the minimum goes up in proportion. But for the most part, whatever you put the max contribution amount at, your minimum required premium that you have to do is about anywhere from about 1/4 to 1/5 of that. So just like with my friend putting in $50,000 a year, or actually lately put in $100,000 in a year, he's in his almost 50 years old right now. For him, he put in $100,000, but his minimum is only roughly about 20, I think it was like 21,000 a year, 22,000 a year, something like that. He's in good health, so it helped. So yeah, that's the thing. Is like if you can put away at least 5 or 10,000 a year, and that even includes people that have stopped contributing their 401ks because they find out with the match doesn't really make them much more money long term, and they can actually take this money, use it to invest in real estate and other things now to make passive income now versus locking it away from yourself and you can't touch it. And if you try to touch your own money, you get slapped with penalties and taxes. That's just wrong, guys. That's horrible. So that's why a lot of our people quit 401ks, they quit 529s and start doing things like this. And they even stop just putting money in their banks. They put money here. So that's what I recommend. All right, looking at other stuff. Let's see. Okay, we got the links to the website. Of course, you can always talk to us, and we even got a direct calendar link as well that we put in the comments there. Kirby, you mentioned you are 70 years old, right? So, I did mention that you could do policies on your kids and grandkids. That's very true. You can still do policy on yourself, and that's usually required. But sometimes you do on your kids and grandkids, even business partners. If you have a spouse that's younger, especially if they're healthy too, that's a great way to go too. So I've had people that are in great health, even at age 69, even sometimes 70, do it. It can work, but usually I recommend if you're in great health, like you're in good shape, that could definitely work out for you. So here's the thing, guys. Like ultimately, like I said, like that guy that sold me a policy, it ticked me off so badly. The only reason I'm doing this, the reason why we have this as one of our niches is because we can't find somebody consistently to do it right for you. And I got so sick and tired of seeing people getting ripped off, literally paying thousands more a year than they should be in costs and fees, when you could actually be using use that money instead to invest, make more money now, create more passive income now, and just do so much better, guys. It's so much better. I'll even tell you, like I forgot to put this in the presentation as well, or I forgot to mention this, but I did an example in another podcast where I showed somebody who just used cash to invest to create passive income versus somebody who uses this with that. You know what's crazy, guys? The one that just used cash in that example, after 10 years, they got to 110,000 of passive income. Using this along with that strategy got them to 121,000 of passive income. So it got them actually to their goal about a year sooner than what they were trying to go for. When they were trying to go for that 100,000 plus a year, it actually got them there a year sooner by using the strategy. So guys, when you couple this with investing, especially when you're doing things like real estate and whatnot, it's amazing. And by the way, can you use this money for? That's one question I get all the time. You can use the money for whatever the heck you want. You can blow it in Vegas. I just don't recommend it. But this is something that can be used to create more safety, get you away from banks, get you to a place where you can feel like you're confident. You don't have to worry about interest rates. You have to worry about, what the banks are going to do or inflation or anything else. You have to worry about stock markets because if they tank, it doesn't affect us at all. It's completely independent of all those things, paying you just regular, stable, predictable returns over time. And that's why it's become my savings account of choice. So guys, again, if you have any questions, of course, or anything else, you can always reach out to us, moneyripples.com, go to the Contact Us page. There's also the link that Danielle put in there too for a calendar link. You can do that as well. Elisa, I will answer that question really quickly. The thing is, like, is there a value or ability to do a large initial dump in or deposit into the policy first, or do you continue to pay it as needed? Would that be useful? There are people out there that teach that, and I'll tell you what, I just saved one of my friends $100,000 in the first year by getting him not to do that. They were trying to have him put in $750,000. This guy actually interviewed me on a podcast, funny enough. Sent me it. He made it seem like it was a friend's policy, but it was actually his own. He was trying to put in $750,000 a year. I showed him, even if he did that strategy, he would still save over $100,000 a year with us. But I told him, don't do that. Instead, he's doing just $250,000 a year instead, and actually getting more cash to grow over time, and it saves it better. So there's an art to this as well as a science that really helps with that. Reese, kids policies are smaller. That is very correct. Usually you can put in anywhere up to 5, 10,000, sometimes even 20,000 or more, depending on how much insurance you have on yourself. I have one client right now is putting 12,000 a year on both of his sons. And they're preteen, they're adolescent, about 12 years old or so. Funny, what's kind of cool is that he's pulling their money together to go buy properties. And then those assets are what's going to pay for their college. So they're not just putting the money in there and let it sit, which you can do, but they're actually going to use that to invest. And then that pays for college. Another friend of mine, another client as well, that's a real estate investor, you know what he's also done? He actually has taken that. If you guys know this, if you're a business owner, this is huge. If you're a business owner and you don't know this, this is key. you can pay your kids over $12,000 a year tax-free. It's a write-off for the business, but the income is not taxed for your kids. It's only when you get up about $13,000 or more a year, you start getting a little bit of tax on your kids. So what is my friend doing? He's paying his kids $12,000 a year, and then he's using that money to fund the policies for the kids. So he's like, wait a minute, Chris, like if I do it that way, I am getting a write-off of my taxes because it's a write-off expense for paying my kids. They don't pay tax on that money. So it's really like tax-free money going in. It grows tax-free and then it comes out tax-free. And then if I invest in real estate, you get tax advantages. There's more tax freedom there where I essentially don't get paid. I don't pay taxes on that money. I could essentially have a tax never scenario using my kids' money. And the answer is yes, you could. Theoretically, right? Again, things can change, laws can change. But the good news is whatever policy you set up at that time, whatever the tax rules are, they stay the same. Unlike 401ks and IRAs, over time, if they change the tax rules, you have to go along with it. These life insurance contracts are contracts, they're agreements of the current rules. So if it's tax-free at that moment, even if they change the tax rules, doesn't matter. You can make that work too. Can you use this for grandkids? Potentially, yeah, you can. It gets a little bit trickier with grandkids because they usually want the parents to deal with it. But there are ways to do that too. It just depends on the situation in the household and that kind of stuff. So anyways, great questions, guys. Appreciate it. Any more questions, you can, of course, reach out to us, moneyripples.com. Appreciate you guys being patient. I know you guys hung in there, especially with the lightning storms, everything else. But, again, I wish you the best. And again, if we can serve you in any way possible, especially if this can lead you to financial freedom today, where you can live your life now, not tomorrow, that's the key, guys. So make it a wonderful day, and we'll see you later.